right, so let's begin the show. And today on the show, as an expert, I have with me Shweta Rajani, Head Mutual Fund, Anand Rathi Wealth. Shweta, hi, good evening, welcome to the show. And Shweta, we've discussed this a lot of times on our show with you as well, and even advised our viewers, chasing past return is not exactly the right way to select a fund. But then what can we do since last 3 years, the kind of rally, especially market rally that we are witnessing, people and investors have a lot of FOMO. Even now when the markets are volatile, I mean, it's good that we are seeing very high SIP numbers and we are seeing a lot of retail interest coming into equity markets. But there's also this FOMO and there's also this pattern of chasing past returns. One really needs to taper down their expectation as far as this year is concerned and the investment strategy is concerned. But having said that, we are talking about chasing past returns. I just want you to help our viewers understand what exactly the kind of funds are we talking about where investors are, going into and giving those funds place in their portfolio. What fund categories and market cap categories are we talking about?
Hi, good evening, Kavita. Good evening, everyone. Like you said, we've seen this. Investors tend to chase past performance because it's clearly FOMO. But before I get on to the categories, I want to highlight that what we have seen is the investor behavior actually is different when they're looking at investing in a particular asset class and when they're investing in the product category within the asset class. Because if I look at the investor behavior in the last 3 months, they've been around 18 months where the markets would have given negative returns out of those 36 months. And the flows have been positive in the market even in those months. So it's really that when you're looking at investing in equity, you're looking at long term and you have to have a forward looking approach rather than having a backward looking approach. And therefore, you don't stop your investments there. But when it comes to mutual funds, we've seen that funds or categories which would have done well in the recent period, also I would call as something like a recency bias plays out. So if something has done well in the last 6 months, 9 months, investors do tend to invest in those categories. And a classic example of this would be a categories like mid cap, small cap, multi cap. If you see, given that in the last almost 2 years, mid and small cap has significantly outperformed large caps, you're seeing more money flowing into these few categories. Another category where I have seen, and we all have seen flows coming in are thematics, where you've clearly had biases again playing out there, and like you said, people chasing the most recent past performance showing up out there. So if you've had something like a particular sector doing well, you would see money flowing into those categories. But if I'm looking at purely diversified categories, yes, mid small cap oriented categories have seen more flow coming in clearly because of the performance.
Uh, Shweta, what exactly is the fear, when we just chase past performance? All that, looking at the past performance become one of the grounds where we can analyze a fund manager's strategy. But then going as per this particular mandate, what would be the grounds to analyze the strategy way ahead, going ahead that the fund manager might want to opt for? Because the markets are forever volatile and they are changing their course. In order to understand a fund manager's strategy and in order to understand the kind of expected returns or potential returns in the near term or maybe slightly a medium term outlook, how can one look at the past performance aspect as well?
Sure. So, first, let me highlight what's the disadvantage of purely looking at past returns and taking investment decision. And, we've done this study, we call it as quartile analysis. And what it shows is if I'm looking at the last 10-year period, I break it up into, 1 year blocks, 6 months block, 3 year blocks. Had anyone looked at the past returns and invested in the top 25% of the universe, which means the top 25 best performing schemes of the last 1 year, 3 year, 6 year, data shows that 70% of the times the top quartile fund turns out to move into the next or the bottom three quartiles. And the reverse also works. So if you had a scheme which was in the fourth quartile, which means the past performance was among the bottom 25%, almost 65 to 70% of them actually improve in the following 1 year, 2 year period. So that shows that cyclicality plays out in funds, and therefore people have to look at data points which are beyond the past return when they are taking investment decision. Like you said, of course, what becomes important is to have a futuristic or a forward-looking approach. One way to identify that is look into the portfolio of where the fund manager is invested and try and understand what is the quality of that portfolio. What's the earnings outlook looking like for those sectors and the companies where the fund managers invested, and then take a call of whether this could, it may have had a good performance in past, but going forward, can that still do well? That's one way. I would say, another way of identifying the agility or the consistency of the fund manager's stock picking capability is see how across different market cycles the fund manager has displayed agility. What's the active calls the fund manager would have taken, and what portion of the portfolio is being actively managed? Because the higher active management of the portfolio means that the chance of an outperformance goes up. Second, if the fund managers displayed agility, that is again an indication that the fund manager is constantly revising the portfolio depending on what the market conditions are indicating. So if one example, let's assume it's a flexi cap fund where the fund manager has flexibility to move across market caps. One check on how the market caps have been changing for the portfolio, as well as what the churn of the portfolio has been, what the style change has been. When value has been doing well, has the fund manager tilted the portfolio to have those value stocks in the portfolio? Or when the growth as a style was forming, has the fund manager tilted towards growth as a style or no? Or at least maintained a balanced portfolio or no? So these are few indications that one should look at in the portfolio and then take their investment decision.
How would you explain this for a passive investment style? Here we can definitely talk about and dissect a fund manager strategy, but when it comes to passive, there also we are seeing a lot of investor interest, and although that returns which we might see on passive index or ETF would be mirroring a benchmark as per the market trajectory, but there's a lot of FOMO even there. So how can one look at that investment?
So, if you dissect that entire index space, and you're right, there's a lot of money that's also gone into the index space. But if you just look, leave aside the last 1.5 year, almost 85% of the money that used to go into the passive space used to go in the traditional indexes like the Nifty 50, the Sensex index, or, the Nifty 100 index. But what has changed is a lot of the smart beta strategies in the passive space coming in. You may call it as momentum as a strategy, you may call it as high quality, low volatility. Those factors are bringing in some kind of uniqueness in the passive space. And, clearly, if in the passive space you're getting which is something which is different than your traditional indexes, investors are chasing that, thinking that there's some innovation that's coming in which is not available in the active space, most likely. So that's where the money is going. It's not, chasing the past performance of these indexes, but it's the exposure, which is something unique that's perceived, which they are entering into.
Sure. All right. I'm sure we have a lot of other aspects to cover as far as this topic is concerned. But then it's time for a quick break, Shweta, and then we will continue the topic and also connect with our viewers who have sent across their questions for life financial planning on the show. So a quick break, and I'm also flashing our WhatsApp number and email ID where just in case you want to send across your questions now, you can do that. And I am with Shweta Rajani, and we will do our viewers life financial planning now. I have with me Mr. Chiranjit. Hi, good evening. How are you doing?
Good. How are you, ma'am?
I'm doing good. Thank you so much. You're calling from Pune?
Yes.
Okay. You've got 9 funds in your portfolio. Motilal
Yeah.
Oswal Nifty 250 small cap, JM aggressive hybrid. You've got Quant small cap, DSP Nifty next 50 index, Motilal Oswal mid cap, ICICI Bharat 22 fund of fund, Parag Parikh flexi cap, Nippon India large cap. You also have Nippon India Nivesh Lakshya. Okay, total SIPs of 59K. I just want to know your time horizon because you've got a couple of goals lined up for yourself. It's retirement, you want to buy a house, and also child education. If you could just give me the time frame for these goals and the corpus that you might need to accumulate.
Sure. Thank you. Basically, so my time horizon is around 15 to 20 years, and my target all corpus is almost same, like 10 to 15 crores. So which will have my child education as well as I want to buy a home and also for the retirement. So I just want to know like whether I need to make some changes into my portfolio or I have to increase the amount to reach that corpus, or is it sufficient? I mean, with the big funds that I have.
Sure. So all of these goals are going to come together? Just one after the
Not
another?
together. Yeah, one after the other. Yeah. So first will be my child education and then home. Like
Sure. That will be after 10 years.
Yes.
Child education after 10 years. We will count in education inflation over there. Home. What's the amount that you're looking for tentatively? I mean, just in case I want to, add in a little bit inflation, what's the amount that you're looking for? Like a ballpark figure. I'm sure you'll be taking a home loan as well.
Yes. So most probably I will be taking a home loan around 50 to 60 lakhs. So like I need to have a down payment and other stuff by like 40 to 30 lakhs of the down payment.
So 12 years from now for the house goal, is that okay?
Yeah. Yes.
And after that, after 15 years, you have the retirement goal, is that right?
Yes, that's right.
Okay. So Shweta, it's 10, it's 12, and then 15. The amount that he's looking for is actually 10 to 15 crores. Because it's going to be one after the another, I don't think so he'll have a lot of time. But yeah, funds and the amount of investment that's going in.
Absolutely. So Chiranjit, first I'm going to address on the goal aspect of the portfolio. Today you're doing somewhere around 59,000 of an SIP per month. You will have to step this up by 10 to 15% in order to be comfortable, to achieve your all the three stated goals that you've set at the required time period. So step it up. That's point one. Coming to your portfolio, see, for most of them, you have a long-term horizon, right? You're looking at around a 10-year or plus kind of horizon. Now, if I look at this period, there's historical data which shows that, if you have stayed invested in equity for a 7-year plus period, you'd easily get more than 6% what generally debt offers. So therefore, if you have a longer time horizon, you can have a portfolio which is equity heavy. Of course, depends on your risk appetite, but you could have anywhere between, I'd say 75 to 80% equity. We've generally seen, those allocations in equities for a 10-year plus horizon. And therefore, where I'm coming to is in your portfolio, you have two debt funds. One is, the Nippon India Nivesh Lakshya Fund, and then you also have the Bharat 22 FOF. So if your overall debt allocation is more than 15-20%, then you don't need these two debt funds in your portfolio. So, you can consider eliminating that. You have index funds in your portfolio that again would bring down your overall portfolio return. Active funds, given the way the fund managers manage it, have the potential to outperform the index funds after cost by around 2-3%. So therefore, I would suggest you to exit from the two funds of DSP and Motilal index funds that you have in the portfolio. Apart from this, you have one hybrid fund. That again, I would say, once you've decided your overall equity debt allocation, manage it separately. It will bring in more efficiency than having a hybrid fund in your portfolio. So these are the few exit recommendations I have. What instead you can add to your overall portfolio could be a Canara Robeco multi-cap fund, a DSP equity opportunities fund, and if you want an IPRU dividend yield fund to the portfolio. So, that would bring in a good diverse or a good blend of different categories and different fund manager styles to your overall portfolio.
All right, you need to also step up your investments. Chiranjit, is there anything else you want to ask Shweta?
That would be it. Thank you so much.
All right, thank you so much. Okay, Shweta, let's take Mani Maran's question. This is via email and he's written this from Bangalore. Currently he's 48 and want to invest for a corpus of 3 CR in next 10 years. He's been investing since last 6 months. ICICI Blue Chip, Motilal Oswal Large and Mid Cap, Parag Parikh Flexi Cap. He's got SBI Multi Cap, SBI Aggressive Hybrid, Nippon Small Cap. And he wants to know if he can step up his SIP by 15,000 and how is the current allocation and also his exposure across fund categories. And so Motilal Oswal Large and Mid Cap is doing SIP of 2,000 since last 4 years. And he's also increased his allocation now to 20,000 in last 6 months. And the same thing he's done with SBI Aggressive Hybrid also. And he wants to know if this strategy is working for him to take him closer to his goal. So, okay. Shweta, 3 CR.
So Mani, coming to your overall portfolio, given the objective that you have of getting to a 3 CR, you would need a minimum 10% step up in your SIP. So definitely do that. And here again, I was going through your query, and this is a classic example of trying to chase past performance and taking your investment decision basis that. I'm going to take a minute to explain. See, Motilal Oswal Large and Mid Cap Fund, you said it's given you a phenomenal IRR of 40%, and therefore you stepped up your SIP to take it up to 20,000 versus an SBI hybrid fund, which is an aggressive hybrid fund, which is given you half the IRR of N Motilal. See, you have to understand these two funds have a different objective altogether. One is a hybrid; it's 70% equity, 30% debt, and within that 70% equity, almost 52% of that would be large caps. On the other hand, you'll have a Motilal Large and Mid Cap Fund where it's 100% equity, and again, it's almost 55 to 60% mid cap in the portfolio. So it's but natural if in the last few years, mid and small cap have done way better than large cap, your Motilal fund would outperform your SBI fund. But that doesn't mean that you should increase so significantly your SIP allocation to one scheme and make it a concentrated portfolio. So definitely you need to bring down your allocation to the Motilal SIP that you've done. A few other recommendations, I think 2 schemes where I would ask you to exit from is one, the hybrid fund.
Right.
If this is your pure equity portfolio, then just have equity funds, and the Parag Parikh fund that you have, the Flexi Cap fund. Instead, what you can add to your portfolio is an HDFC Flexi Cap and an SBI Contra scheme.
Okay. I think that will be all, and we are done with the timing of the show as well. Thank you so much, Shweta, for being on the show today. And for all our viewers, I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.